Okay.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning, welcome to the show as we kick off the new month of August, and lots of exciting things already happening. So on Friday, we got the employment report that came out weaker than expected. Of course, that started kind of a sell-off on Friday that, on concerns about, recession risk rising. We talked about the SOM rule on Friday as well. So if you go look at our website, I wrote an article about the SOM rule, but really it's more about employment indicators in general. Now, even the creator of the SOM rule right now that says that when unemployment is 0.5% above the average, that you're typically heading into recession. Even Claudia SOM says maybe that's not the case this time because of liquidity, etc. But markets certainly looked at it on Friday, sold off into that because of concerns about rising recession risk. Also, the Fed's now really starting to cut rates. The expectation now is that it could be even as much as a 50 basis point cut come September. That's also typically the Fed cutting rates when recession concerns are rising. So, that certainly weighed on the markets on Friday in general. And again, you take a look at that employment report really underneath the covers, so to speak. Headline was, 100 was below estimates, but still over 100,000 jobs created. So, still a decent employment report, but underneath the surface, right, as we've been talking about for a while, the numbers really don't look all that great. And that's not really surprising. A lot of this economic data that we've seen as of late continues to come in weaker than expected. Today we had ISM manufacturing also back into contraction territory. That's kind of also leading, kind of into that, concern about the overall economy. Now, we're going to do a little bit longer before the bell this morning because a lot of stuff going on this morning that we've got to cover. But, so that started the sell-off on Friday, right? So on Friday, markets were down decently. But over the weekend, something that we've talked about previously is the Japanese Carryt Trade, which now appears to be blowing up. So Here's what you need to know before the bell this morning, the extended version, right? The director's cut. So a lot of things happening here. So, all right, so first of all, let's talk about what a carry trade is. And this thing's been going on for years, right? So this is nothing new. The carry trade's been going on for at least, as far as, I'm aware, and kind of in mass, at least 20 years. So this is not a new thing. But what the carry trade is that I short the Japanese yen. So I'm a hedge fund manager here in the United States, so theoretically, right? So, and I've got a few $1 billion at my disposal to invest. So how can I maximize that trade? Well, I can short the Japanese yen, and I do that by shorting the Japanese bonds, which have basically a zero yield. So I now am short Japanese bonds, effectively the yen, with a bond that has a 0% yield on it. I then take that money, right? So when I short, I'm selling something I don't own. So I now have money. I've sold something that I don't own, the Japanese bond, and I take that money and I buy U.S. Treasuries with it, which have a yield of some sort, right? So it's been somewhere between 1, 2, 3, 4% over the last 20 years. So I now have this spread on the yield, right? So let's just do some math here. Let's say I short $10 million worth. Now hedge funds are doing this in a lot bigger numbers, but I need easy math. They short $10 million worth of Japanese bonds. I come over here and I buy $10 million worth of U.S. Treasuries. U.S. Treasuries, highly liquid, government guaranteed, great collateral, right? And I'm also picking up the spread between the zero interest rate and the yield on the Treasury. So I'm already making money on this deal. Now, this is where it gets fun because I can then take those Treasuries and leverage those 10 times, right? So now I can take 10 million in Treasuries, turn that into $100 million that I go long equities with. And this is where a lot of this buying power has been coming from over the last, last couple of decades for the stock market has been this massive carry trade. Well, everything is fine and dandy until something goes wrong. And over the weekend, something has now gone wrong because the dollar is crashing sharply. This is the inverse of what's happening with the yen, which is going straight up. So all of a sudden now, there is an unwinding of this carry trade, right? And so when it's leveraged, it requires a lot of selling to unwind that leverage. Again, I took 10 million in Treasuries, turned that into $100 million worth of equities, right? So I'm gonna have to sell a lot of equities to unwind that carry trade. So this is what happens when margin goes wrong, for lack of a better term. And this is showing up across asset classes, really across the board. But importantly, what we're seeing is one of the largest spikes in volatility this morning, at least, that we've seen going all the way. We have to go back to the pandemic to really see a similar spike in volatility that occurred back during the pandemic. Here's the pandemic when we shut down the economy. Here's the spike in the VIX this morning. So again, we haven't seen a spike in volatility like this in quite some time, but this is that unwinding of that carry trade. Now, here's what we've talked about before that's so important to remember. The markets are fine, right? So, and I told you before is that, hey, if you're worrying about Iran or, Taiwan or whatever it is, right? The deficit, the debt, that's not the thing that spooks the markets. Right? What spooks the markets is something called an exogenous and an unexpected event. In other words, something the market wasn't counting on. This is it, right? This doesn't mean the world's going to crash and that we're, in the next major bear market, right? Doesn't mean that at all. But when you get these kind of one-off exogenous events like the unwinding of this carry trade, it can create a whole lot of panic in the overall market because right now, participants in the markets, these hedge funds, have no choice, right? They are getting margin calls at this moment, and they're saying, I have to liquidate this position because of what's happening. So this is going to lead to selling all across the board this morning, not just in stocks. Bitcoin is having a big meltdown this morning. It's down over 12% right now as well. So again, it doesn't really matter what risk asset you're in this morning. It's going to be down this morning, whether it's stocks, whatever, it's going to be down. If it's a risk asset, It's going to be down this morning. Nasdaq's going to be down about 4 or 5% this morning. Right now, we'll see kind of where the market. Dow's down about 700 points right now at the open. Implied open for the S&P is down about 160 points this morning. So if you take a look at the S&P, where we closed on Friday, we were about 532. So you can clip 160 points off that. So we're going to be approaching, somewhere around 5,200 this morning, 5,150. So we're going to start approaching that 200-day moving average this morning at the open. We'll see. But one thing about this, and again, so this is where I want you to relax just a little bit, is that markets are deeply oversold here, particularly this morning. So we went into this already in a correction. Now you have this spike in volatility. So the markets are going to open down sharply. Do not be surprised if we don't see buying come into the market this afternoon, right? That would not be surprising at all. We could see kind of a knee-jerk reaction. The market opens down this morning. We immediately see buying coming back into the markets because we are already so oversold at this point. That would not be surprising to see that happen. Importantly, one thing that we've been talking about for a while is that bonds, have really been doing the yeoman's job of supporting portfolios during this decline. They're going to do that again this morning. Yields are down fairly sharply this morning because money is now coming out of risk assets, going into safe assets. That's that hedging ability of treasuries. And again, over the last couple of days, we've already seen big jumps in bond prices. That's going to be again this morning. So, in the portfolio, like on Friday, the portfolio held up very well because bonds did their job of hedging the portfolio risk. This morning, it looks like they're going to do exactly the same. But again, bonds are very overbought. Stocks are very oversold. Won't be surprised to see a reversal even potentially by the end of this day. So be careful making knee-jerk moves this morning. Let this market play out today. We'll come back tomorrow, take a look at it, sort out what we need to do, and then make changes from there. Okay, that's what you need to know before the bell this morning. We'll be back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, all right, let's talk about a few things here this morning just to kind of keep things in perspective because, again, it's very easy when you're seeing a lot of headlines this morning coming out Stock futures fall as global sell-off intensifies. Recession risk around the corner. What it is. So you're going to get a lot of people out over the next day who are talking about, the recession's here. Stock market's going to go down, et cetera. Now, look. So first of all, let's just put things into somewhat of a perspective. I've already gotten a bunch of emails this morning, and it's like, I'm losing money. What do I do? First of all, we're not losing money because the markets are still up roughly 10% for the year from where we were. So yes, we've given up some gains from where we started the year. And again, we've talked about this correction coming for a while, right? So again, when you kind of get in the middle of that corrective process, it's easy to, and again, the media needs headlines to, really, get people to click, watch, and view, right? So I'm going to start retitling all of my article. All my videos will now be something doom and gloom. So to make sure that y'all click and watch the video. But, you're going to see a lot of this. So again, it's going to be emotionally driven, right? You're going to kind of feel this need to do something. I've got to do something, right? Just be careful. This is why we've been talking about bonds a lot lately as a hedge, and they're doing their job exactly what they're supposed to do. So there's no reason to panic sell, right? And to do things just because there's a big bunch of negative headlines. Now, that doesn't mean there's not risk to the markets, right? But nothing goes straight down either. So, again, as I said, markets were already oversold going into today. They're going to be extremely oversold this morning. I would not be surprised, but if by the end of the day, we don't see some buying. Now, it doesn't mean we're going to get back into positive, but we've seen these days before where the markets opened down 700, 800 points on the Dow and then finished up 1,000 points by the end of the day. Go back to the pandemic, take a look at some of those days. And so that can certainly happen. Now, I don't expect that we'll get back to positive today. It's possible, but I don't expect that. But, to finish well off the lows would not surprise me at all because the markets are so oversold. If we weren't as oversold as we were going into today, then we might have a different conversation. And I'd be saying, hey, look, take some more risk off, pretty quick. But again, if we've already taken risk off the table, we've already hedged portfolios a bit. So we're okay right now, right? So there's not a panic to do something. Now, do I want to de-risk some more? Yeah, I think I do after today, right? But we're so oversold and the market needs to bounce a bit, go back to support, which will now be the 100-day moving average, which we will take out today with some volume, and that's important. But a rally back to the 100-day moving average is likely going to be a really good spot to reduce some risk further. So let the markets come back to you. Let the markets kind of give you an opportunity to sell and to reduce risk further if you need to. Now, if you don't need to, you don't need to do anything. You're fine, right? But what's important is that what the market is showing you today is really cutting through a lot of those memes that we've heard over the last couple of months, right? It doesn't matter what asset you own this morning other than bonds, it's going to be down, right? Gold is down. Gold's supposed to be a hedge for the dollar, right? Well, dollar collapsing, gold down. That's not supposed to happen. Stocks are down, right? Earnings have been good, really, for the most part across the board, but stocks are down. Why? Because it's a risk asset. So anything that's a risk asset, if an asset is traveling upward, right, and Wall Street can leverage themselves into it, they're going to do it, right? So the trade has been short the Japanese bond, go long U.S. Treasuries, buy stocks, and that's okay, especially when the yields on the 10-year Treasury at 5%. That was a hell of a trade. I'm getting 5% on my money to sit there and do nothing. And then I can leverage that and go buy stocks, which are going up. I can buy stocks, buy gold, buy Bitcoin. It's all going up. So I just leverage into all those rising assets. Well, now the margin calls come, right? So now the banks get the call, hey, you've got to reduce that risk. They have to sell everything. And then they go buy more bonds because Treasury bonds are the safe asset. That's your risk-off asset. When you don't have any place to go, you go to Treasury bonds, which is what we're seeing today. But again, as I said, bonds are now very overbought. So you don't want to go buy bonds today. Today's not the day to sell stocks. Today's really not the day to buy bonds. It's really kind of a day to do nothing. Just let this sort itself out today, and then we can come back and see, okay, where do we need to make some changes, if at all. But again, I wouldn't buy bonds here because bond yields are going to be 3 standard deviations overbought this morning, if not 4. So it's a huge move. Bonds don't normally move that way except in these type of events. But this is also brings up this other conversation that we've had is that, again, we've had this conversation on the show before where we've talked about, all these reasons that people have about the markets, right? It's the debts, the deficits, it's this, it's that, it's this other thing, whatever it is. And, we've said on the show before, it's never those things, right, that gets the market. And again, what causes the market to sell off like today, as a good example? It's because something happened that the markets were not aware of. They weren't, that wasn't in their choice of picks about what was going to be the risk event. And when these exogenous, unexpected events occur, everybody has to go risk off all at once. See that, and that's what causes these large declines in stocks and a big jump in volatility, and it's very painful for a day or two. But this is also where we tend to make our biggest investment mistakes, because this is where we start panic selling and I gotta get out of the market today. It's too late. It's too late right now. Let this market do what it wants to do today. Then calmly, rationally make some decisions about what to do next. Because then you can make better investment decisions about your portfolio, what stocks to own, what stocks not to own, etc. But again, this is this is how markets operate, and this is why it's always very important. All these narratives. And I don't know how many times that we've had this discussion here on the show about narratives. These narratives are always nonsense, right? Because the thing that gets you is the thing you don't see, right? And it's like really, it's always kind of humorous that the healthiest people in the world, they always seem to die early, right? You never know what it is, but people that I know people that have drank, smoked their whole life, they live to be 150, right? And then some guy that works out every day, he dies 55 of a heart attack. But the point is that you never know what it is. You can be doing all the right things in your portfolio based on these narratives, right? Oh, I'm this narrative I think is right. This is going to happen, overseas or whatever it is, and this is going to be the big event. Sanford and Son, it's a big one, Elizabeth. And so you're built for that. And then the thing that gets you is something you weren't even paying attention to. And that's why I always tell you is man, forget these narratives. They are the worst thing ever on these narratives about getting anything right. And they typically tend to get you on the wrong side of the trade most of the time. So again, just be a little cautious. It's interesting in the chat right now. Michael says, buy when CNBC brings Jim Grant out. and that's pretty much right. I just wrote an article about Jim Grant. Jim Grant was talking about how interest rates were going to go shooting off to the moon because of the debts and deficits. And I wrote a whole article a couple of weeks ago on the website talking about why that's not a fact. And that when something happens and you have a recession or a market event or whatever it is, bond yields are going to drop like a rock. And well, here you go, right? Because again, that part of how money works and how markets work doesn't change. There is only a certain place that investment managers and really kind of global markets go when things get tough. I mean, I'm not going to go buy Russian bonds or German bonds or, any other country's bonds when things get tough. I'm going to buy U.S. Treasuries. Because like it or not, the U.S. is still the strongest economy in the world, and it's the safest economy to have your money housed in, particularly in times of trouble. Also, this brings up the fact that this type of market event today absolutely guarantees the Fed will cut rates in September. And if this market route continues in the next couple of days, don't be surprised if we don't get an intermediate rate cut. Would not be surprising at all. Also, I would not be surprised to hear some Fed speakers talk about potentially a faster reduction in QT. If this is a one-day event and it's over, then no, everything's fine. But if this market route kind of continues, and this is kind of what we talked about in this weekend's newsletter a bit, we talked about the uninversion of the yield curve. That's in the process of working. We may actually uninvert that today. We'll see, because we're very close. We're only like 17 bips off right now of uninverting the 10-year, 2-year yield curve. But that's your signal for a recession. We'll talk a little bit about that. We'll just kind of go through the charts, after the break. But, if we start to see, more of this, and again, I don't expect this correction is over yet, but I do expect that we'll get kind of an inter-correction rally that will kind of relieve some of the pressure, and then we'll have the rest of the correction occur. But that's, be careful, right? So that's just all we're saying here is just be a little careful. Markets are going to get a rally here for a day or 2 or 3. Use that to rebalance risk into versus panic selling right here at this morning. Now, if you're short the markets, take some profits. This will be the place to do that. All right, quick break. We'll be right back.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Now, I warned y'all about the chat rules. Our chat member, Jerome Powell, says that I'm old enough to remember when we used to use well oil for fuel.
Those are fighting words.
The Real Investment Show podcast.
Them's fighting words. But more importantly, what Jerome Powell doesn't understand is that I remember when we had to catch our own whale.
And then turn it into oil.
And then turn it into oil for fuel. So, I mean, that was back then when men were men.
We liked it.
At realinvestmentadvice.com.
Had blubber for days.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Interesting statistic, real quick. So the new Deadpool Wolverine movie is breaking box office records. It's the highest grossing R-rated film of all time right now. So they, of course, this is the kind of reunion of, if you're into Marvel and Disney and all this other stuff, movies. This is the reunite of Deadpool and Wolverine. Of course, that's Hugh Jackman, who, by the way, he's 55 years old and absolutely shredded for this movie. I mean, very impressive. I've been reading up on his workout routines, which I'll be incorporating today, by the way, in the gym. But interestingly enough, in the cinematic universe of Marvel movies, there have been 119 uses of the F-bomb in the movies. Guardians of the Galaxy used it once. Deadpool and Wolverine used it 118 times in the show. So, there's your statistic. It is not a movie for young children, by the way. This is an adult movie, all stretches, by all stretches. But finally, they figured out that, what the audience wants. I think they finally figured out, they completely devastated the Marvel universe after Endgame with Disney's kind of woke environment. There's nothing woke about this film, trust me. But I think they figured out the formula. At least Kevin Feige and Ryan Reynolds, who wrote most of the movie, did a lot. There's a lot of breaking of the fourth wall in media, which is where they talk directly to the audience. With a lot of stabs at Disney along the way. And kind of an interesting side fact about that is they had to submit the script to Disney repeatedly while they were writing it because they had to get approval because they were making jokes about Disney through this entire movie, about the Fox, 20th Century Fox, Disney acquisition and how they messed up. And they actually make direct references to how they basically killed off the big bunch of the Marvel universe. Of course, this whole film is nothing but cameos of all the Marvel characters over time. Everything from Elektra to Blade. They all Jennifer Gardner shows up as Elektra. Wesley Snipes shows up as Blade. So, I mean, they bring back everybody, even Channing Tatum as Gambit, which they actually never had a movie, but he shows up. So, but they break that fourth wall constantly during this movie, and they had to keep submitting the script, and Disney approved everything but one joke. So, yeah, they took a beating in this movie. So, but you have to have it kind of was actually the price of admission. But you have to be a fan of the Deadpool humor. It is not, again, it's a very adult movie, very adult. My wife did not like it because it's not her sense of humor, right? Because there's a lot of sexual innuendos and commentary, but you know, if you can understand the Deadpool humor and how it works, then it's a pretty funny movie. Anyway, let's get back to work. A few things. So there are a few things to pay attention to. Again, so as I talked about just before the break, the risk to the markets right now is really twofold. The first is the unwinding of these unexpected exogenous events that are caused by, now look, let's go back to how the sequence of events works. There are certain things going on within the markets and the economy, things that we know, right? So we've talked about weak unemployment, we've talked about the strength of the dollar, we talked about all these type of things. Those have consequences, right? They're not the event. So as we were talking about before, it's the unexpected exogenous event that causes these big market reversals that all happen in one day, right? The things that we focus on, these headlines, they're the symptoms, right? And so, yes, so unemployment, strong dollar, all these things that we watch, you know, and talk about. It's like, man, the dollar's getting a lot stronger. That has consequences. Because if the dollar gets stronger, then central banks have to buy gold or buy treasuries to hedge off and manage the risk of the rising dollar, et cetera. Well, there's consequences to that ultimately. And the consequences of that show up in the form of something breaking, which is what we're seeing today. What broke was the Carryt Trade. Big collapse in the yen, causing an unwinding of financial markets, not just domestically. This isn't happening just in the U.S., by the way. This is happening globally. So this is the important thing. So let's go to our newsletter this weekend and, talk a little bit about inversions and yield curves. Because, again, this is the one thing that we've talked about for a while, is that when the Federal Reserve starts cutting interest rates, and now we have the first kind of set of events that are going to lead to a rate cut. And in our chat, there was a question like, what do rate cuts do? It doesn't drop, the interest rate on Visa and MasterCard, right? It does a little bit. Those rates will come down eventually. If the Fed keeps cutting rates and lowers that short end of the curve, credit card interest rates will come down, but not right away. So no, the Fed cutting interest rates doesn't really help the average everyday American that much. It affects variable rates, but not a lot. Where it shows up, of course, is in the financial markets and in the credit markets. And as you take a look back at history, whenever the Fed cuts rates, yields on bonds fall. Because, again, two things, very important things to understand about Fed rate cuts. Fed rate cuts only control the short end of the curve. So that's the 3-month to the 2-year Treasury bill. That's about all the Fed controls, is on that very, very short end of the curve. Now, what is that? That is your money market rates. That's your Visa, MasterCard rates, your variable rates, those type of things. That's what's kind of controlled by that short end of the curve. The long end of the curve is controlled by economics. That's inflation, that's wages, and in fact, if we just look at a composite index of wages, economic growth, and inflation, there's a very high correlation between that economic composite, that's the red line, and 10-year Treasury rates. Now, this isn't updated for today, obviously, because rates are going to be a lot lower. But the point here is that interest rates are going to decline as economic growth continues to deteriorate, and we're seeing clear evidence, really, that across the board. Employment number on Friday really started to confirm a lot of that. So what's important here is that we're now seeing yield curves begin that process of an inversion. Now, the most important thing to remember, as we've said before, is that it's not, and again, we got tons of these headlines that came out when yield curves inverted that, the yield curve is inverted, that means a recession's coming. No, that's not what that means. And as you can see in this chart here, it's when yield curves uninvert, and this shows you to 2020. I'm going to show you a long-term chart here in just a second. But when the yield curve uninverted in 2020, when the Fed was slashing rates and everything else, that was when the recession set in. But we didn't know the recession had set in there, right? We didn't know the recession had started in March of 2020. We didn't know that for about 9 months. And that was when the National Bureau of Economic Research came back out and dated it and said, it started there. So that gray bar of that recession didn't show up for about 6-9 months. And that's normally the case. So when the yield curve uninverts, that typically marks your onset of a recession. I'm going to show you a long-term chart of this real quick. So we track 10 different yield curves. And so the blue line is the composite index of the percentage of those 10 yield spreads that are inverted or not. So it's the 10-year, 3-month, 10-year, 2-year, 5-year, 1-year, all these different variations of spreads. And these are the ones that people, talk about in the markets. They go, it's the one that really matters is the 5-year, 1-year. The one that really matters is the 10-year, 2-year, or whatever it is. So we just said, okay, well, if nobody can really agree on which one's the most important one, let's build a composite index of all of them and track that. And what we see is that when more than 50% of those yield curves are inverted, that's your warning sign. We're at 90% right now. When that number drops back below 50%, that's your recession marker. So as the yield curves begin to uninvert, that we're going to go from 90% inverted to 80 to 70 to 60, and then we get below 50, that's your recession mark, historically. And you'll notice that each time, this goes back to 1980, that each time that we've had a big spike in the number of yield curves inverted, the recession didn't start there. It was when it got back below 50% that the recession started. And a good example of that is 1995. We didn't have, everybody talks about the Fed hiked rates in 1995 and it was a soft landing in the economy. Okay, but the Fed hiked rates, but yield curves never inverted in 1995. It wasn't until 1998 that we started having some yield curve inversions, but we didn't get above that 50% mark until 1999. So there was no recession warning in 1995. There's no recession warning right now, okay, at the moment, until we get back below 50. But there's certainly evidence that we're going to be heading there potentially fairly quickly. All right, we'll come back. We're going to wrap up the show, what all this means to your money and your markets, your portfolio, and we're going to answer, a few other questions we got going on this morning. All right, don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. We have 1,000 people watching the show this morning, so thank you for being here. And I certainly hope I'm gonna jump into the chat, try to answer a few of your questions. I'm trying to keep up with y'all. Y'all are moving pretty quick, but I've seen a few pretty good little topics kind of run through here that I want to kind of go through real quick. But again, while you're here, be sure and like and subscribe to the channel if you haven't already. Certainly appreciate that. Just click the little bell icon as well. We'll alert you when we post new videos every day. And be sure and like the channel. Certainly appreciate it and like the video. All right, so let's jump. So a couple of questions like my gold miners are selling off this morning. Yes, everything that is risk related. Gold's down 1.5% this morning. Of course, it didn't have gold didn't have the big run up like we saw in a lot of other, stocks and things that went up. Nvidia, Microsoft, Apple, AMD, they're all going to be down sharply this morning, mega caps in particular. But everything that is risk related, Bitcoin's going to be down 13% this morning. It's back below 50,000. It doesn't matter what you own. If it's a risk asset, it's going to be down. If it's a safe asset, i.e. bonds, they'll be up. So bonds and cash, those are going to be pretty much the only winners today. Now, there's going to be some stocks in our portfolio. There'll be some stocks in the market that will be up today. Those are going to be your defensive stocks. I bet if I went and looked kind of at stocks like Procter & Gamble, things like that, I bet that those are pretty much going to be either near flat or actually Procter & Gamble pre-market's up 0.5%. So there's going to be some stocks that are up today, but those have been the stocks that have been least liked, recently, and there'll be more interest rate sensitive stocks. So I wouldn't even be surprised to see like some real estate stocks up today, potentially some utility stocks might be up today. We'll see how the market opens this morning, but that's going to be kind of the flavor of the day. But pretty much if you own risk assets, for the most part, they're going to be down. And if they are dependent on leverage, in particular, those are going to be down a whole lot more. So we're going to kind of see this across the board. So again, as I said earlier, one thing not to do today is panic. Right. So, gold miners will be down 5.5% this morning. Right. So again, those are leverage plays. So again, as don't knee jerk react to the markets this morning because you've had this exogenous event. It's unexpected. This cracking of the yield curve. This cracking of the leverage, the carry trade. And that's running through the markets right now. It's just causing everybody to deleverage all at once. And so when one group starts to deleverage, another one does, so forth and so on and so on. It just kind of cascades on itself. So again, just be careful this morning. Now, again, I won't be surprised if by the end of the day, we don't see some buying come in. That wouldn't be surprising. Now, doesn't mean it has to happen. We've had days where markets just opened down and stayed down all day. But this is a pretty drastic down this morning, and we're going to see a lot of stocks hitting support levels this morning and very, very deeply oversold levels. So again, to see some speculative buying kind of come in trying to buy the dip won't be a surprise at all. And we'll obviously update that tomorrow. A couple other questions, in here as well. Just when you see, big jumps in volatility, again, that's that emotional kind of knee-jerk reaction that occurs. And again, what's happening is that the markets are giving up gains, right? As I said earlier, there's a big difference between losing money and giving up gains. Markets are up big this year. Like, for instance, Nvidia this morning will be down roughly 10% at the open. It's going to go back to where it was in March. It's still up big from where it was in January. So, it all depends on where you were buying assets. But as we talked about last week, be careful of anchoring, right? Our natural tendency is to anchor to the high water mark. This is where I was a month ago, or as of July 31st, my portfolio said I was at $100,000 and now I'm at $90,000. I'm losing money. No. Where were you in January? Where were you 2 years ago? Anchor on that. So, and the reason for that is so we don't make emotional decisions like, oh my gosh, I got to get out, I'm losing money. No, you're giving up gains. There's a difference. We don't want destruction of capital, right? We don't want to actually go into negative capital value. That's what we want to avoid. Market valuations, the gains, those are going to fluctuate over time. What we want to protect is that capital investment value. So pick a date, 1 year, 2 years ago, whatever it is, that's your capital value. And you can adjust that. So you use, where were you 2 years ago? Let's say you've been investing for 10 years. 2 years ago, I was at this level. That's my new capital value. I'm not going to give up that number. Next year, you move it up a year. So it's always kind of a two-year trail. That'll keep you anchored to a realistic value. That's your new capital. The gains are going to fluctuate. We don't want to make investment decisions based on fluctuations of markets. We want to make investment decisions based on our capital values. So just kind of keep that. That'll help lower that emotional kind of volatility that we have in the overall markets. Now, look, there is a lot of speculative trading that goes on. And that is the one thing that gets hurt the most. And we're going to see a lot of, we saw a lot of young people piling into options trades and long calls, no puts. We wrote some articles here recently about absolute complacency in the markets. Those are great setups for these types of reversals. And this is why speculating in markets turns out so badly so often. Because I go very long out on that risk curve. I've got no hedges of any sort. And then when the market reverses like this, one morning I wake up and I'm down. And again, if you're long, just your whole portfolio is nothing but call options, you're not down 2 or 3% this morning like the markets. You're going to be down 15, 20% or more this morning. Because options are the most leveraged trade out there. Again, there's nothing wrong with using options. We use options in one of our in our platinum portfolios. We use them to hedge, right? We use them to hedge risk. We don't use them to speculate. So options can be very beneficial to use if used properly. It's like a gun. Guns can be very beneficial if used properly. They can be very dangerous if used improperly to you personally, right? So there's going to be a lot of young investors, and we've talked about how many of these kind of young people that have been in the markets for just the last few years are taking on a lot of speculative risk, particularly post the pandemic. We've seen a lot of these zero-day options, et cetera, where young people are piling into these things, taking on a tremendous amount of risk. When that reverses, that's the problem. So this is, one of the issues as investors and the things we want to pay attention to mostly is just that the markets go through these events. First rule is not to extrapolate today's event into a bigger negative narrative. There's going to be tons of headlines out today. It's like, this is it. As I said earlier, Elizabeth, this is a big one. This is not necessarily the event that leads to a major market crash of 20 or 30%. Could it be? Maybe. But you can't tell in just one day. Now, we're going to see lots of headlines. The world just broke. Some version of that. We won't know that for a while. Maybe it has. What we need to do now is focus on the day-to-day. Market's going to be very oversold today. Lots of negative sentiment today. Big spike in the VIX today. Go back in history. Those types of events tend to mark near-term market bottoms. Doesn't mean the bottom. Near-term market bottom. You get a tradable rally. Use that rally. Look, and what have we been saying for the last month, right? Use the rally, reduce risk, rebalance portfolios, blah, 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 right? Y'all were tagging me in emails like, you say this every day, and market keeps going up. This is why we do that. Now, your opportunity is going to be take that cash that we took from rebalancing and, kind of reducing risk, et cetera, in our portfolios. We now have that opportunity to step in and say, hey, look, there's a whole shopping list of stocks that are now on sale. I've been really wanting to get into this company or that company, but it's been too overbought, too extended. Now I have an opportunity to buy that. I wouldn't do that just yet. That's not today. not today. But this is where we want to start building that shopping list. We're going to get a rally in the next day or two, if not even today. Where that rally takes us, we'll keep you updated every day this week. Will be our focus of our before the bell all week, is going to be where this market is, where we get a tradable rally to, where to take some more money off the table. The next decline will probably be your buying opportunity. But that could still be another couple of weeks out, maybe a little longer. So again, we're going to have to navigate. Right now, we're going to have to navigate this day to day. But don't panic today. Don't let media headlines and YouTube videos, etc., drive you into make emotionally driven mistakes. Best thing to do is turn everything off today. Just go do something else. We'll look at this tomorrow. All right, have a great day. Thank you so much. Be sure and like and subscribe to the channel. We appreciate it very much. And we'll see you back here tomorrow for the next edition of The Real Investment Show.